Hello everyone, I'm Ravi Handa and welcome to another episode of Desi Fire podcast. In today's episode, we are going to talk about what does an early retirement portfolio look like. And I'm going to take my example, obviously. So, I will talk about what sort of strategy I'm following, how I'm withdrawing, and I will also talk about what are the mistakes that exist in my portfolio so that when you build yours, you don't make them. I hope there are some good things in my portfolio as well from which you can learn and hopefully do a better job than I did. So let's begin. For my early retirement portfolio or fire portfolio as I like to call it, I follow the bucket approach. As you can see on the screen, there are four broad buckets that I have. The cash bucket, which has around 8.5% today. The long opportunity bucket, which has another 9-ish percent. The medium term bucket, which has around 16%. And the long term bucket, which has around 67%. Now, what do these buckets mean? What is there in these buckets? We'll talk about it in detail a little bit later. But the broad idea is simply this. Whatever money that you need sooner rather than later comes in the short term, the cash bucket or the liquidity bucket. Whatever amount of money you need in the medium term comes in the medium bucket. Whatever amount of money you need in the long term comes in the long bucket. So these are the buckets that exist. And every once in a while, let's say every 6 months is when I do it, near Holi or Diwali is when I move around the money in these buckets. How do I do it? What is there in these? Let's get into the detail. So, first of all, even before that, what is not really covered in this? I don't really consider real estate as a part of my retirement portfolio because of multiple reasons. A, it is not very liquid. That's the biggest one. So I have not included my primary residence. I live in a flat. That's not really included in it. I also own a small piece of land on the outskirts of the city I live in. That's also not included in this. Crypto, I don't really have too much exposure in crypto. Roughly around 1% of my portfolio would probably be in crypto, or maybe even lesser than that. I don't really include that because goes up, goes down, we don't really know what's happening. And I also have a bit of startup equity because I worked in startups. Couple of them have done really, really well. Couple of them became unicorns eventually. Actually, one became unicorn eventually and one was already a unicorn when I joined. So that's there. I've also done a few angel investments, but all of these, very well could go to zero at any point of time. So I don't really include those things in it. Let's go ahead. First of all, we are going to talk about the cash and the long opportunity buckets. Now, in cash, what I typically keep is around 4 years of expenses. So that's where I am right now. The idea is to always have enough cash for meeting all your expenses which are there. In case you have to pay the school fees, whatever plans you have. For example, I'm not really planning to buy a car right now, but the car that I have is already 7-8 years old. I hope I will be buying another car in the next 4 years. So whatever expenses I believe will happen in the next 4 years, that is what I keep in my cash bucket or liquidity bucket or whatever you want to call it. So I do have some provisioning for car in it currently. That's essentially the reason why you see this number at around 8.3%, so to say. Now, what is the returns that I expect from it? Returns that I expect from it are typically in the 6 to 8% range, which is the current expectation right now because we are in May 2024, interest rates are close to the top. The idea over the long term with this bucket is because I'll always have this bucket, I'll always have a portion of my portfolio in cash. is to generate whatever is the government inflation plus 1%. As long as it is able to generate a little bit more than that, that's good enough. How do I generate it? For that, there is another bucket, which is the long opportunity bucket. Now, once again, the money in it is extremely liquid. The reason why I have this another 9% of my portfolio in this is in case there is a market crash that happens. Now, I don't know when the market crash would happen, but if it happens, I need liquidity to take advantage of that particular position. In case there is an opportunity which comes up which I want to invest in. For example, I keep making every startup investment every now and then. Where do I get that money from? That comes from the long opportunity bucket. That's the asymmetric bets part. The rebalancing part. I do believe there are problems in my portfolio which need to be fixed. For example, I'm just giving an example and we'll get into the detail of it later. I don't really have too much gold in my portfolio, which I believe is a mistake as an early retiree. So I need to have more gold. Where do I get the money for that? So again, I will invest this. I have had this opportunity bucket for quite a while, and I have gotten my gold from 0% in the portfolio to maybe 2.5% of my portfolio over the last couple of years. I'll keep on increasing it till it gets to somewhere in the 5 to 7 or maybe even 10% range. I don't really know what that number would be, but all that money comes from the opportunity bucket and I need liquidity for that. Once again, the returns are 6 to 8% government inflation plus 1 because both the cash bucket and long opportunity bucket, their money goes into the same assets. The key criteria for these is that the money should be extremely liquid and I should be able to take it out at any point of time without being worried that, oh, is the market doing well? Is the market doing poorly? Whether I have access to it or not. So these two I keep in very liquid assets. What are those assets? Debt mutual funds. Those form the biggest portion of my cash and long opportunity portfolio. It is also, there is a little bit in NCDs, there is a little bit in MLDs. And these are all forms of debentures, or you can say bonds to a certain extent. There are alternative investments that I have in Giraffe, Grip Invest, Vint Wealth. I did a video on alternative investments. If you want to check it out, I'll link it in the description. The top funds which are there in this particular portion of the portfolio are HDFC Low Duration Fund and ICICI Short Term Fund, which have around 30% and 20% of my cash and the long opportunity portfolio. So once again, just to give a summary, 4 years of expenses, that's around 8.5% here, plus the car, around 4 years of expenses, a little bit, around 9% is in the long opportunity bucket. Cash, I will maintain that 2 to 4 year period in cash forever. That's actually what the plan is. I will come to it. The opportunity will obviously go up, go down as I keep on investing money wherever I want to put that money in. Then, what are the problems with this particular part of the portfolio? Too many products. As you can see, I have NCDs, MLDs, there is some money in Giraffe, there is some money in Grip Invest, and even in Giraffe, I have multiple deals that I have subscribed to. Even on Grip Invest, there are multiple deals that I have subscribed to. It becomes a problem to maintain all of them. I wanted to try stuff out. That's why I made all of these investments. And they have given pretty decent returns. So these are not 6 to 8% returns. So I've gotten 12, 14, in some cases even 16% returns in these. But I'm not comfortable. Because I'm putting so little money in these that even if it generates that 14%, 16%, what difference is it going to make? For a portfolio of mine, which is, more than 10 crores and lesser than 15 crores. That's broadly the range that we are talking about. For a 10-15 crore portfolio, if you're putting in 3 lakh rupees in an asset which gives you 16% instead of 6%, what difference is it going to make? And that too for a year. So that's a problem with my cash portfolio. The risk that I have is too high in some of these products. I have actually lost money. So I invested a little bit of money in one of the deals in Grip Invest, and the company that it invested in, the founder left the country, and that money is gone for all practical purposes. And that happens in alternative investments. You should be aware of it, you should be prepared for it. The other problem in this is that I have 13 debt funds. That's a bit too much. It doesn't serve any purpose, so to say, by having so many different debt funds. Why I have them is because some point of time, okay, fine, let's get this one from HDFC. Oh no, credit risk fund sounds nice. No, there is this banking and PSU debt which is slightly better. There is credit risk. Now there is credit risk from HDFC. ICICI does better credit risk. And all of this happens if you keep on investing over a long period of time, which is what I have been doing, and you don't really know about products and you keep investing in them, which is, once again, that was a mistake. I didn't really know exactly where I was investing. So I kept on piling on various funds, and that's a mistake that I have made. Does it get me subpar returns? Not so much. So I don't really think having too many funds is a bad idea if you are looking at it from a returns perspective. Having too many funds becomes a bad idea purely from a management perspective. It's a headache. It's an unnecessary headache that I have taken on myself, and I'm in the process of fixing it. How am I fixing it? So I have funds which will have a little bit of money in them. So some fund that has maybe 1.5 lakh rupees, I would rather sell that first and at least reduce one line from my Excel portfolio. I'm no longer making any fresh investments in alternatives. There is money that is coming back. Some of the deals that I subscribe to will end in 2025, I believe. That is when I will be free of alternatives if I don't make any fresh investments. I'm trying not to do that and bring down the number of debt funds. The other problem which happens is a lot of these debt funds, or rather almost all of these debt funds, were purchased before March 2023. So they have favorable taxation. Now, just because I want to reduce the effort of managing these funds or reduce the number of debt funds, should I move to a taxation which is unfriendly? Obviously not. I'll put in that little bit of effort. The effort that we are talking about here is 4-5 hours of effort over a period of 6 months. That's when I make changes to my portfolio. So I believe it would happen. Then the medium term bucket. Now, before I get to the medium term bucket, so what happens in the cash bucket is I keep 4 years of expenses in it. I'll keep on consuming, I'll keep on eating from it. I'll buy the car, I'll buy the t-shirt, I'll buy the mic from it. And the money will keep on going down. Every 6 months, I will take a call near Holi and near Diwali is, do I need to refill this bucket? So if I have to refill my cash bucket, what I will do is I will sell something from my long-term bucket and put it in cash. How do I decide that? I will come to it. So if the market is doing well, how do I decide that the market is doing well, or what parameters I consider? I'll come to it. I will sell something from here and move it to cash. So cash keeps on going down, then every 6 months it will bump up. Now it is possible that I don't bump it up a particular instant, or I don't bump it up in a year. It is possible that I do not bump it up in 2 years or 3 years. That's why 4 years of funds are there. In case the market is doing poorly for a period of 2 years, 3 years, for even 4 years, I don't really need to worry about it. I will keep on consuming money from my cash bucket and I will not touch my long term bucket. In case it continues, the bear market phase continues more than 4 years. And that's possible. I haven't seen that happen. I don't really think that has happened in India in the last 30, 35 years. But that has happened in other economies. That has happened in Japan, for example. That has happened in China, for example. That has happened in the US in the late 20s, as an example. So it is possible that it happens in India also at some point of time, that the equity markets perform poorly for more than 4 years. If that happens, that is when the medium term bucket will come into the picture. If that doesn't happen in my lifetime, well, all good. The medium term bucket will keep on continuing and will become my inheritance. But in case a bad phase, a bear phase lasts for more than 4 years, that is when I will dip into the medium term bucket before I hit my long term bucket. So the idea is fairly simple. If the markets are doing okay or if the markets are doing well, I keep on moving money from my long term bucket to my cash bucket. I do not touch my medium term bucket. If the markets are doing poorly for a long period, for 5 years, for 6 years, for 7 years, then I touch my medium term bucket. So in my medium term bucket, I have 6 years of expenses roughly. That's what I essentially target. So from today, for example, I don't think it will happen that right now when we are recording this video, the markets are, the Nifty is close to 22,000, a little above that. In 2034, the Nifty, if it is still at 22,000, that is when it would become a problem, because I'll consume my cash bucket first, then I will consume my medium term bucket, and then I will have to sell equity. I don't want to be in a position where I'm forced to sell equity, and this medium term bucket gives me that buffer that I will never be forced to sell equity. And that's the main purpose. I use it in a prolonged bear market. The other benefit, or why a lot of people use it, is to generate cash flows. So you buy such products in the medium term bucket is that they keep on generating a little bit of cash, so that your cash bucket lasts longer. It has 4 years of expenses. There is some income that keeps flowing in from the medium term to cash, and people achieve that with dividend stocks are considered a very good example. I don't really understand the stock market well enough to put substantial chunk of my money in dividend stocks. I do have a little bit of stocks. We will get to it a little bit later. But I don't understand it. I don't do it. But that's something that you can consider if you have an idea of the stock market. You have high dividend yield stocks, so they'll keep on throwing some cash for the cash bucket. And what I have is I'll show you the expected returns from this particular bucket. I expect to generate an 8 to 10% return from it. Once again, in May 2024, this is what I believe a decent number, or 8 to 10% would be, which is match my personal inflation. When I talked about the cash bucket, I was essentially talking about the government inflation plus one. Now I'm talking about a personal inflation. I believe my personal inflation would be somewhere in the 8 to 10% range. I had planned, when I started this, I had planned for an expense between 20 to 25 lakhs. When I retired 2 years ago, my expenses are very well in that 20 to 25 range. They have not broken that range yet. But at some point of time they would, and whatever is the rate of growth in my expenses, I believe that's the same sort of returns I will get from the medium term bucket. What do I have in this medium term bucket? I have gold in it, which is around 11% right now. I would want it to be significantly higher. And by gold, I mean sovereign gold bonds. That's the only form of gold that I have. Anything else does not make sense. At least it does not make sense to me. I don't really understand how it makes sense to anyone else. But for my portfolio, I don't really think I'll ever have any other form of gold. Until and unless one of you is generous enough and give me a chain or a biscuit, I'll gladly take that. But from my own money, I'll probably stick to sovereign gold bonds. There is a little bit of debt in this portfolio, and there are hybrid funds in it. I have just two hybrid funds in it: ICICI Balance Advantage Fund and HDFC Hybrid Equity Fund. These are the two that I have. There is a debt fund that I have in this, which is the SBI Magnum Gilt Fund. Once again, I do believe in May 2024. I actually got this in March 2023. In March 2023, I believed that Gilt Fund was a really good idea. I still believe in May 2024 that investing in a Gilt Fund is a really good idea. At some point of time, it would change. And when it changes, that's when I will shift money out of it. And hopefully by then, my gold, I would have purchased more SGBs so that 6-year, 7-year figure is maintained for my expenses. I don't believe there are any problems in my medium-term portfolio, and if there are no problems, then there is nothing that is required to fix as well. Then coming to the long-term bucket. So this is the money which is supposed to, whatever money that I have left goes into the long-term bucket. For example, I hope it happens, there is one of these startups that I have invested in. I have hopes of money coming back from it. I'm expecting, close to a crore coming from it, maybe in the next year and a half. So suppose I get that money, then will I still maintain these 8-9 percentages, etc.? No. Whatever money I get from that, I'll consume some of it, party with it, maybe buy a fancier car with it. But the bulk of the money will go into the long-term bucket. So suppose you give me 100 crores tomorrow, all goes into the long-term bucket post-taxes. So I don't really define how much money should go into the long-term bucket. For me, as of today, it's 2/3 which is going into it. But it could be 80%, it could be 40%, whatever, is left after your immediate cash needs are met and your medium-term bucket is filled. So when I started this particular journey of FIRE, I had close to 40 years of my 40x or 40 years of expenses in it. So 4, 6 and 30 is a good distribution that I had at that point of time for the long-term bucket. So 4 years, 6 years and the next 30 years. So that means 75% was there in my long-term bucket, and let's look at what the number is right now. So 4 here, 6 here. So if I add these two, so 66 and 9, so it's still pretty close to that 75% number which is there. Okay. What's there in it? So what's the purpose? Growth. It should grow. The return should be inflation plus, and I invest in assets where they are supposed to beat inflation over the long term. So what is there in it? So bulk of it, as you can see, 61% is in index funds and some active large cap funds, which will broadly give you the returns of very, very close to index. There is around 12.5% which is there in flexi cap, contra, mid cap funds, value funds, and basically non-index plus large cap funds. There is around 11.5% which is in Videshi index. So that is S&P 500 is something I have, a little bit of NASDAQ is also something that I have. I have an HDFC World Indexes fund, which invests not only in the US but in the other markets as well. And there is around 15% in retirals. So retirals are NPS is a part of retirals, EPF is a part of retirals, PPF is a part of retirals. So these are government schemes which are typically used for retirement by traditional retirees. So that's the retirals part of the long-term portfolio. Then, what are the problems? Long list of problems here, and once again, none of these problems, I believe, are strong enough to derail my returns or derail my portfolio. These are not blunders, so to say. These are inconveniences, is how I would put it. So suppose if you have to go and watch a movie and you book an Uber, and the Uber guy doesn't really turn on the AC. It's an inconvenience, but it does not really hamper your movie experience too much. So this is the part where the AC is not turned on. It's nothing more than that. I can call them mistakes as well, because this has happened over a period of 15 years that I have been investing. International exposure is very, very low. I do believe that a much higher portion of my funds should be outside India. Now, it's low right now. Maybe India does really well over the next 5 years, a decade, or whatever period it takes me to fix this. So I might be on the beneficial side of it. And I do believe India would do, the Indian equity markets would do better than international markets over the near future. But as a concept, I do believe having all of your funds or almost all of your funds in just one country when you are retiring, there is no other source of income, there is no way you can make up for these mistakes. You need to have a much higher international exposure. Yes, gold helps a little bit, crypto helps a little bit. So you have some assets which can be considered international assets, but I don't have that much gold. I don't have that much crypto. That's why I want to beef up my gold part as well. So that's a problem, because I started investing in international funds, I believe, in 2021, or maybe 2022. 2021 or 2022 is when I started investing in, 2020. So just last couple of years, but I have been investing in equity since 2008. And because I have been investing in equity since 2008, that's the other problem. That's the 27 mutual funds is what I have. So one of the reasons for 27 mutual funds is because my portfolio is distributed across multiple family members. So I look at all my family members' money as my money, as our portfolio. So suppose I have an HDFC Nifty index fund, then I'll have the HDFC Nifty index fund in my portfolio also, in my wife's portfolio also, and so on and so forth. There are 8 regular funds that I have, and I'm not a big fan of the regular fund category, but to sell them just because you will save a little bit on the expense ratio and you will have to pay taxes on it now. Again, I'll do it at some point of time when I have to sell equity for rebalancing, for filling my cash bucket, or whatever the reason might be. But as of today, yes, I do have 8 regular funds in my portfolio, which is a problem. And it's stuff that I've collected over a period of 15 years. Bulk of it has been over the last 10 years. And 13 of these funds that I have less than 1% of the portfolio. What am I going to do with that? If the fund does very, very well, so, but if it has less than 1%, then what difference is it going to make? Nothing. If it does poorly, again, not too much of a difference to the portfolio returns, but it becomes a little bit difficult to manage. So that's a problem which I'll need to fix. there are 4 active large cap funds that I have, and 2 of them are very small. 2 of them are in this 1% portfolio category, but the other 2, HDFC Top 100 and SBI Blue Chip, I have huge investments in them. I don't really have the numbers, but they form a substantial chunk. And those are the ones that I believe I need to get out of, because I don't really have enough faith in active large cap funds beating index funds over the long term. And even if they do, good for them. I don't want the headache. I want to be in index funds so that I don't have to even track and discuss, oh, how is your mutual fund doing and how is my mutual fund doing? Because doesn't matter. I would rather have lesser returns. I don't think there will be lesser returns, but I would happily have lesser returns and not have the headache of figuring out which is the best fund. There is also direct equity that I have picked up. Thankfully, very, very little. So I have around 10 stocks which form 1.5% of the portfolio. So, it's stuff that I have picked up. Some of it goes back to even 2008 when I started investing in the stock market. So I don't do that anymore. That's a problem that I have gotten away from, but they exist in the portfolio. Once again, I don't believe selling them just because it will reduce a line item on your Excel is a good idea. I will sell them as and when I need the money for whatever reason. So what are the fixes? Buy international from long opportunity. That's the long opportunity bucket. So it will go into startups, it will go into any project that I am planning, it will go into international funds. Buy non-large cap from long opportunity. As you can see, my equity portfolio is very focused on index funds and large cap, because the index funds that I have, they are also Nifty 50 and Nifty Next 50. That's it. There is, no mid cap index or small cap index or anything like that I have. And I do believe I need a better exposure to the non-large cap category. And that would, once again, the money would come from long opportunity over a period of time. I need to sell the regular funds, I need to sell the active large cap funds, and I need to sell direct equity. All of this I'm not going to do today, I'm not going to do tomorrow, I'm not going to do in 2024. I am going to do as and when required. When to sell and what to sell, that decision is taken on the basis of asset allocation. So A is the part that, okay, do I have 4 years of expenses, etc. in it or not? But the most important decision-making tool that I use is this particular pie chart. Where is my money right now? So my money right now, around 28% is in debt, around 52% is in equity, and hybrid is around 18%. What do I mean by hybrid? So hybrid is mutual funds. ICICI Balance Advantage Fund is the biggest fund in my portfolio. Once again, I believe, it's definitely more than a crore, should be around 1.3, 1.4, I don't really know. Hybrid equity fund is another hybrid fund, as the name indicates. NPS, my wife have investments in NPS, so that also comes into the hybrid category. Gold also I consider into the hybrid category. For calculation purposes, I consider hybrid as 50-50. 50 equity, 50 debt. And so if you look at it that way, you will see that equity, so half of it would be around 9. So this is around 61-62% is in equity right now. My goal is my equity exposure should always remain between 60 and 70%. That is how I decide what to do. So let's say, you remember that 4 years should be in the cash bucket. At Diwali, I will check what is my equity exposure. At Diwali, if my equity exposure is 67% or 66% or 68%, I will sell and refill the bucket. I sell at Diwali and I check, okay, how much is my equity exposure? If it has come down to 57%, 58%, 59%, I will not sell. At Diwali, if my equity exposure has come to 55%, or below 55%, then I will use the long opportunity bucket to bring it to 60 to 70%. 60 to 70% is a range that I'm comfortable with for my equity exposure. I have rules on rebalancing. Probably I'll make another video on, when do I decide how to sell, what to sell, and all of that. But the decision making starts based upon this particular chart, which tells me how much I have in my equity portfolio. And as of now, I don't really think that there is any change that is needed in it. As a matter of fact, it had gone up to around 65, 66 odd percent. And that's why I sold and refilled my cash bucket, so to say. I took out the money that I might need for a car also at that point of time. So I have done that around Holi already. So I don't really need any further changes are needed in it. And we will revisit this discussion around Diwali. And I believe this is the last slide of today's presentation, which gives me an overall picture. This tells me what to buy. Say, for example, I'll decide based upon this when to sell equity, so to say, and when to sell or when to buy. But what exact asset I should be buying, that gets defined by this. So if I look at my total portfolio, index plus large cap comes to around 38%, hybrid funds come to around 12%, flexi contra mid comes to around 8%, debt is around 24%, Videshi index is around 7%, gold is 2%, and retirals are around 9.5%. The biggest problem in this, I believe, are these two. Gold is too low, it needs to go up. I have been buying gold systematically. Every time an SGB comes out, I make sure that I buy 50 grams or 100 grams. And if I keep on if I continue doing that, hopefully this percentage would go up. Videshi index is broadly whatever I think the last purchase that I made was in March 2023, because that was the time when the taxation on global index funds or global mutual funds changed. After that, I have not made any purchases. But let's say if there is an opportunity that comes where the US market has crashed substantially more than the Indian market. I don't really think that's going to happen, but let's say if it happens at some point of time, then I would buy, the Videshi index. Or let's say if both the markets have fallen, then I'll buy a little bit of Videshi index and I'll buy a little bit of flexi contra and mid. I don't really think I'll be buying large cap funds or the Nifty index fund or the Nifty Next 50 index fund, because I am overexposed to those. So that's broadly what my portfolio looks like, how I make decisions with respect to my portfolio. Hope you guys got something to learn from this, and I hope sincerely that you do not make the mistakes that I have made over the last years and created the problems that I have for myself. Once again, I would like to emphasize that these mistakes are not big ones. These are not really problems that can derail your financial planning. These are inconveniences. So keep that in mind. If there is someone who has 27 mutual funds across 4 PANs or something like that, you are not alone. We are in the same boat. So that's it for today. Hope I've earned the privilege of your time. Thank you.